Welcome to the Planet MicroCap Showcase Virtual 2022. Thank you for joining us. I'm your host, Robert Kraft. And now presenting is Chris Dobbin, CEO of Nova Leap Health. It's a publicly traded company. The symbol is NLH on the TSX Venture. Chris, take it away.
Thanks again for the introduction. I appreciate you guys having me on. I've been part of this presentation in the past, and I've always enjoyed it, particularly those that are tuning in from the audience. I expect there's generally two types of folks that tune into these presentations I've found in the past: those that have really followed us along for a number of years and are likely current investors and have been for some time, and those that are interested in learning a little bit more about our history and our path forward. So to those two groups, I appreciate you tuning in and listening. So Nova Leap Health Corp, this is our 2022 presentation. It is available on the website. So you can download that at any time. We've got forward-looking statements, obviously, from a legal perspective. I'll talk about our plans going forward, but refer back to this as you're going through the presentation. Investment highlights. I'm going to go through this slide, but what I will say is that we started this business through a capital pool corporation back in 2016. We've been fairly active on the acquisition front. We are in the non-medical private pay home care space. I'll take you through what that is. I think we've achieved quite a bit over the last few years. But as I sort of think back of our history, it's really been 5 years this month since we started being quite acquisitive. It was November of 2017 when we started making some acquisitions into Rhode Island and New Hampshire. And I'll take you through the map later on in the presentation of where we are. But effectively, for those that are Canadian investors, we've gone from virtually the concept to just under $40 million of annualized revenue, and for our U.S. investors, that equates to roughly $28 million plus of U.S. annualized revenue. So it was interesting. I had a Canadian shareholder the other day that I was speaking to, and he said, I still consider you very much a venture stage investment. And of course, we're traded on the TSX-V. But it was interesting to me because, at roughly $40 million Canadian in revenue, that would be a pretty good size private business, but understandable in the venture market. As a public company, we're still quite small. So what do? We provide primarily home care. So think about in-home care, where we go to seniors' homes and we help them out. And this could be activities of daily living. Our market tends to be those that live with dementia, and so those are multiple stages. Alzheimer's, there's over 200 types, but again, this could be early stage dementia or later stage. We help with both, and normally it's the seniors that recognize they need some form of assistance, and so they'll hire one of our agencies, or the adult children recognize that mom or dad needs some assistance, and so they'll hire us. So it's usually one of those two ways, and more often than not, it's the adult children that recognize there's something a little off there, and mom or dad needs a little bit of help. So I'll take you through a little bit, but we are in primarily the private pay market. So our revenue stream is derived primarily from out of pocket to seniors or the adult children that we end up invoicing. We do also do Veteran Affairs, which is a government reimbursed program, as well as long-term care insurance, which is obviously administered through the insurance company. So for those that are in the U.S., we're not in the Medicare and Medicaid space, and for those in Canada, we're really not after the government-funded programs. Again, it's primarily a private pay type of model that we operate in. And in terms of our split between non-medical and what's considered to be home health care on the medical side, it's predominantly on the non-medical side that we operate, and that's the space we've been in since we started 5-6 years ago, and one that we continue to like going forward. Got a couple slides here on the industry. I do think this is a story that's easy to understand in terms of, really we have an aging demographic. We have folks that, once they attain the age of 65, there's a high likelihood they're going to have at least one chronic or long-term condition, and that's what's leading to the need for assistance within a home. So I think everybody gets the aging demographic, and in this slide in particular, we talk about those that have Alzheimer's and dementias and so on. What ends up happening is that as people age, there's a higher likelihood the percentage of those living with dementia does go up. So for example, those 90 plus, would have a higher percentage in that population than the 80 to 85 and 70 to 75 and so on and so forth. So there is an increasing percentage of the population that lives with some form of dementia as they continue to age and live longer. And of course, nowadays we know with advances in medical care that we are living longer. So where are we? We started the business, with our head office in Nova Scotia. We have operations throughout Nova Scotia. We operate in the Northeast, so think about New England, Vermont, New Hampshire, Mass, Rhode Island. We're down in Kentucky, Indiana, Ohio, South Carolina, and then we skip over to the Midwest where or South Central, where we operate in Texas, Arkansas, and Oklahoma. The types of businesses we're looking for, I'll take you through. Really, it's pretty simple. These are small businesses, mom and pop businesses, certainly by definition. Oftentimes these smaller home care agencies operate with a couple $1 million of revenue. I think the average in the industry, last I heard, was about 1.9 million. So really, small agencies that we're looking to acquire. U.S. and Canadian geographical focus. Obviously, most of our acquisitions have been in the U.S. But we look at both countries. Just there seems to be more opportunities in the U.S. when we look at those businesses. Positive EBITDA and strong brands. So you think about what we're acquiring. There's no capex, no tangible assets. It's not like we're acquiring a facility. This is really a service-based business where we're going in and providing care within somebody's home, or providing the service within a facility on a one-on-one basis. And so we're really, inheriting a client base, obviously, that comes with the purchase, and good people. And the way our structure works is there's typically 3 to 4 people within an office location, and then there's a number of caregivers, out in the field providing the actual service. And that number could vary from, 50 to 75. We have an agency that has well over 100 caregivers. So, it varies, obviously, but that, should give folks a sense of really the structure of our agencies. We have here a 5+ year operating history. I'd say, 10 to 15 would be ideal. That those are the type of businesses we would prefer, those with a much longer, track record. Those are great businesses for us to acquire. Opportunities for operational synergies. I'll be careful here. These are not highly synergistic acquisitions. You think about, again, we're providing one-on-one care. Are there some synergies we can get through back office functions and technology? Sure, but I don't want to leave people with the impression that there's some massive synergies that you get as a result of buying smaller businesses. That's not really the case here, or the reason that they're making the acquisitions. And we generally try to buy between 3 to 5 times EBITDA. They're pretty stable businesses. Revenue is pretty predictable in a given year. Oftentimes we look at a $2 million revenue business. It might have been 1.9 the year before, or it could be 2.1 and back to 2. It's usually within a pretty tight revenue band. And so you just, you manage your office staff and billing rates and caregiver rates, and you've got a good little business. So 3 ways for us to grow primarily, with the first 2 being the predominant ways we do. Organic growth. And so give an example from Q2 to Q3, I think we increased our revenue organically by about 2.2%. Acquisitions we've made, I think 19 over the last few years. And we have significant plans for acquisitions going forward. Joint venture partners is something we've looked at, but we haven't found the right opportunity yet. And that's why I say organic growth and acquisitions are the primary drivers of our business at the moment. Our financial profile, again, this is really going back to the early history of the company and just showing, our consistent and steady increase. On the left-hand side of the chart is the revenue side, and so this is annual revenue. So back in 2017, roughly $1 million US of revenue, obviously a tiny business. This year, or 2021, 21.2 million of revenue. We've already surpassed our 2021 numbers by the end of Q3 this year. I think by probably $200,000. So we have obviously one quarter left to go. We operate on a calendar year basis, so the revenue numbers will obviously be better than what they've been as we finish up the year. Annual adjusted EBITDA, again, there's our track record there. And then we show pretty much the same thing on a quarterly basis on the right-hand side of the chart. So top right, quarterly revenue. And again, I always sort of compare this to a stock chart where you have some ups, it's a little bit of pullback and ups again, and you see a dotted line down the middle that shows the impact that COVID had on us, and we definitely did see the impact of that, for the better part of a year or so, and we're coming out of that. So the biggest challenge in the industry right now continues to be the access to caregivers, and so if we had more caregivers, then I would be pretty comfortable in saying that our revenue numbers and adjusted EBITDA numbers would be even higher, because the demand in the market is there. We just can't meet the demand that currently exists, and really it's just the access to good quality people that's a bit of the barrier. I'll make a comment on the quarterly adjusted EBITDA because I think this is important. We do try to operate, much like a private business, and what I mean by that is trying to make decisions for the long term and not just for the short term. And I think that's important because this is going to fluctuate on a quarter-to-quarter basis, and it could be because we're making investments in personnel because we have growth plans going forward, and we think we might want to hire in advance of where we think we're going to be, and that could have an impact in bringing down our adjusted EBITDA, in a given quarter. But we know that we're making the investment because we obviously think we're going to have a financial benefit in the future, and so oftentimes we'll see EBITDA go up, maybe pull back a little bit and go up again. Oftentimes it's driven by those types of investments that are longer term in nature, but could have a negative impact on adjusted EBITDA in a given quarter. The target metrics is something that we put out back in, I guess, November of 2021. What we're trying to do here is give a sense of where we're going. And the reason for that is because investors are always asking the question, what could be your consolidated EBITDA margins and so on. And because you've got to understand our business, we have obviously two operating segments. So we have the US and the Canadian operating segment, and they produce adjusted EBITDA. And then we have head office costs, which are really the M&A and the accounting support functions, and all the different insurance and listing fees and cost of being public that we have. And so what we do is as we add agencies to our overall organization, we should begin to see that leverage, that operational leverage. And so we should increase the consolidated EBITDA going forward. And so this was, we put this out to show a potential path forward in terms of what we're trying to achieve. And by the end of 2026, so thinking about on an annualized basis, we're targeting $100 million US of revenue. And right now at the end of when we just reported Q3, we're 28.3 million. So it shows the gap that we have to fill as we're going forward. A lot of that will be driven by acquisitions, and some of that will be driven by organic growth based on our expectations. And so, that should lead to roughly a 10% consolidated EBITDA margin. We're doing far better than that in our Canadian segment, and we have some room to improve in the US segment as we come back from COVID. So, those are the plans we currently have in place. There's nothing to change our mind from our perspective right now in terms of achieving those. If there is down the road, obviously we'll make adjustments to this and let the market know. The management team, again, this is a head office management team, so I'm responsible for the business, and our accounting functions and M&A functions exist within the Halifax office. Obviously, we have tremendous regional directors and folks that run our businesses in the US on a day-to-day operational basis. Those folks aren't depicted on this slide. From a board of director perspective, there's 6 of us, including me. We have 5 independent directors, 2 of which, Dana and Michael, have been with us since we founded the business back in 2016. Great board that adds quite a bit of value, and it's been fun to work with. Our corporate and capital structure, I'll touch on this. A couple of things that I think that are important to highlight. Roughly 86 million shares outstanding, fully diluted, roughly 93 million, no, almost 94 million. We do have about 38.8% insider ownership, and I think that's important because insiders have led pretty much every round as we financed the company since inception, and we've been buyers in the open market on a pretty consistent basis. So I personally believe that the board and the management team should be aligned with shareholders, and I think we've done a good job of that. We all have significant money at risk in the business, and I think that allows us to make good long-term decisions. And I think, hopefully I certainly think that's a good alignment with shareholders. So I'm very comfortable with the insider ownership that exists within this business. We do have a tier one bank, BMO Bank of Montreal, which has been supporting us since the early days. And I think in our last press release, we actually indicated at the end of Q3 that by the end of 2023, our projections are we'd have about $265,000 worth of bank debt left, which is obviously a pretty small amount. So, at the end of Q3, we're sitting with 2.2 million US cash on the balance sheet. Good working capital situation, good banks, good bank debt situation. We've got some promissory notes to repay, but overall, I think we've got a pretty strong balance sheet, and are well positioned going forward. We do have some analyst coverage through both Cormark and Echelon, who are pretty consistent in terms of price targets with us. And they've been covering us for some time now. And then we've got a share price that has really been declining. My belief on the share price that this is simply a timing issue. I think when people discover, how we've done from an operational perspective, people will start to take a little bit more of a meaningful interest in our company. In the meantime, as I said, insiders have been happy to pick up some shares in the market and lead financing round. So overall, I think the message to current shareholders, we're in pretty good shape. There are a ton of opportunities, to continue to consolidate the market. There's no exaggeration when I say there are thousands of these home care agencies that are available to be acquired in the coming years, and I think we're certainly one of the consolidators in the market, and so we expect to continue to make acquisition going forward. So very much appreciate your time today. Appreciate the interest in the company. Glad to be back here presenting to the group, and happy to take any questions.
All right, Chris. Well, thank you so much for your presentation here this morning. A few questions for you real quick. First one, and I'm asking this to everybody who's presenting here. We're managing through tough markets right now. What measures is the company taking to manage some of the macroeconomic pressures currently affecting most microcap companies across the board?
Yeah, I think for us, really, our shift has been more than likely than not an allocation of capital perspective. So if you think about our history, we've been pretty acquisitive, buying companies on average one a quarter. And really, we've taken this time, given the current, the workings of the capital markets, to really just focus on paying down debt. So I think the allocation of capital strategy has been a little bit different for us, and we've just really been focused on debt and haven't been as acquisitive as we have historically we've been. So that's probably been the biggest shift seen in our business. But really, what it's allowed us to do is obviously have a good, healthy balance sheet and be well positioned going forward.
Very good. All right. So then, looking ahead to 2023, from what you can tell us, what are the company's value catalysts that you think folks should pay attention to?
Yeah, it's interesting. You mentioned the word value, right? And I think that's where the market is moving towards. You always see the shift in super high growth, and value sometimes gets left behind. And even though we're a venture type company, I think people look at us as a value type company. We manage the business really, really well. I think we're very careful and prudent managers. I think that goes a long way to becoming a value type company. And for those that are looking for value, in terms of well-managed businesses, as well as the growth story, then I think you get the combination of both those two in Nova Leap.
And then my last question for you here today, from what you can tell us, what are some of the corporate actions and strategies that are being put in place to hopefully accomplish some of the goals that the company is setting for itself?
Yeah, again, I just go back to how we've managed through COVID, how we've sort of made it our way through there, where we've really focused on operations over the last couple of quarters. We made a number of changes in Q2. We saw pretty healthy benefit of those changes in Q3. And so again, we're well structured from a management team perspective going forward. I think our costs are really well aligned. We've paid down a significant amount of debt. Our balance sheet is strong. Insiders led a financing round. I think we put in 82.18% of the private placement. And so again, demonstrates the commitment that the insiders have. And so that shored up our balance sheet. So we have cash, we have a limited amount of debt. We have operational, improvement. And so I just think we have things that are trending in the right direction for a value type business.
Very good. Well, Chris, thank you so much for your presentation today. We really do appreciate it. And for everybody listening in, thank you for watching and enjoy the rest of the event.
Great. Thanks very much for having me.
Thank you.